When you get financial advice, it's pretty easy to just assume that the person giving it to you is legally bound to put your interests first. But here's the thing, that's not always the case. Not all financial advice is created equal, because different advisors are actually operating under very different legal standards. And understanding that difference, it could be one of the most important financial decisions you ever make. Let's dive in.
So let's just get right to the heart of it with the big question. Is your advisor legally required to act in your best interest? Well, the answer might surprise you. It depends. It all comes down to the specific standard of care they're held to, and figuring this out is one of the most crucial things you can do as an investor. All right, so for most of financial history, the bar for brokers was set at something called the suitability standard. This was the baseline, the fundamental rule of the road for decades and decades.
Now, the key word here, the one doing all the heavy lifting, is suitable. This standard just says that a recommendation has to be a reasonable fit for you based on things like your age, your income, your risk tolerance. But notice the wiggle room there. Suitable does not mean best. It just means good enough.
This car dealership analogy just nails the point perfectly. So imagine you go to a Ford dealership, right? You tell them what you need, and it's pretty obvious the perfect car for your family is a Toyota Highlander. Well, under that old suitability standard, the Ford dealer has zero obligation to send you down the street to the Toyota lot. Nope, they can sell you a Ford Explorer because, hey, it's suitable. It checks most of your boxes, even if they know it's not the best option for you, and even if it just so happens to earn them a bigger commission. So, as you can probably guess, all these potential conflicts in the old suitability model, well, they eventually led regulators to act. They decided it was time to raise the bar for brokers, which led to a major regulatory shift called Regulation Best Interest, or as you'll hear it called, Reg BI. And here's the key date you want to circle on your calendar. On June 30th, 2020, the SEC officially put Reg BI into effect. And just like that, it created a new, higher standard for brokers. The game changed from just suitability to now having to act in a client's best interest.
So what does Reg BI actually make them do? Well, it's a pretty significant step up. It requires brokers to prioritize their clients' interests over their own. They have to clearly disclose any conflicts of interest, like, hey, just so you know, I get a higher commission for selling you this product over that one. And they have to exercise professional diligence and care. It's basically a new framework built on top of that old suitability idea, but with much, much stronger protections for investors.
But there's an even higher standard of care out there. It's one that's actually been around for a long time, thanks to the Investment Advisors Act of 1940. This is what's known as the Fiduciary standard, and pretty much everyone agrees this is the gold standard for financial advice.
Just listen to the language here. It's incredibly powerful. A fiduciary has a legal duty to act solely in your best interests. They have to make decisions as if they were you, managing your money as if it were their own. There's no ambiguity. The client's well-being comes first, period, full stop.
This whole standard is really built on two main pillars. First, there's the duty of loyalty. That means the advisor has to put your interests ahead of their own, always. And second, there's the duty of care, which means they have to provide smart, well-researched advice. Together, these things form a basically unbreakable commitment to you, the client. This table just lays out the differences in plain black and white. Look at this. Under the fiduciary standard, it's all about finding the absolute best option with undivided loyalty. But under that old suitability standard, it was just about finding a suitable option, which, could allow the firm's own interests to creep in. The differences in how they handle conflicts and transparency are just as dramatic. Okay, so we've covered a lot of the legal definitions. But what does this actually mean for your wallet? Let's look at a real-world scenario to see just how big the financial consequences can be. Let's invent a hypothetical family. We'll call them the Johnsons. They've got $500,000 to invest. Now their fiduciary advisor recommends putting it in low-cost index funds and charges a totally transparent 1% fee. Simple. But an advisor operating under that old suitability standard, they might recommend actively managed funds that, surprise, carry a 5% upfront commission and have higher annual expenses. Both recommendations could technically be called suitable, but their costs are worlds apart. And this, right here, is the crucial point. In the very first year alone, that 5% commission and those higher fund expenses from the suitability advisor cost the Johnson family $31,000. Wow, that's money that is not growing for them. It's going straight into fees and commissions. This bar chart just makes the impact painfully obvious. Look at the difference in first-year costs. $5,500 with the fiduciary versus $31,000 with the suitability advisor. Now, imagine that difference compounding over an entire retirement. We're talking about hundreds of thousands of dollars.
Okay, so here's where it gets a little tricky in the modern world. A lot of advisors are what's called dually registered. This means they can act as a fiduciary sometimes, but then act as a broker at other times. They can literally switch hats depending on the transaction. And this statistic is just staggering. An estimated 80% of assets at registered investment advisors are managed by these dually registered firms. This creates a huge gray area for investors who think they're getting that gold standard fiduciary care all the time.
So, with all this potential confusion, how can you possibly cut through it all? Well, thankfully, it can all come down to asking one simple, direct, and incredibly powerful question. And this is it. This is the single most important question you can ask. Will you act as a fiduciary for me at all times, and can I have that in writing? Now, the key phrases there are at all times, that's what prevents the hat switching, and in writing, because that makes the commitment legally binding. Their answer to that one question will tell you absolutely everything you need to know about the standard of care you're going to get.
This is not financial advice.